gold just staged one of its most violent reversals in weeks. Yesterday, it was being crushed. Then something changed. Within hours, gold had surged more than $200, hitting $4,527. And now, less than a day later, it's already slipping back below $4,500. So what's changed? And more importantly, is that $200 surge actually holding? Because the force behind yesterday's rally wasn't the Fed. It wasn't inflation. It came from the US bond market. And what happens there next could decide whether gold makes another run higher or gives back a much bigger part of yesterday's move. To understand why, we need to look at what was happening before gold suddenly took off. Long-term US Treasury yields had been climbing aggressively. The 30-year yield pushed above 5.3%, putting enormous pressure on gold. The reason is fairly simple. Gold doesn't pay interest. So when yields on US government bonds rise, investors are being offered a better return elsewhere. That makes gold relatively less attractive. And for a while, that pressure was clearly winning. Then the US Treasury stepped in. It announced an expansion of its buyback program with greater support for longer-dated government debt, and the bond market reacted almost immediately. Long-term yields turned lower, the dollar weakened, and suddenly, one of the biggest forces weighing on gold disappeared. That was the spark. Gold didn't suddenly become more valuable overnight. The environment around gold changed, and the reaction was violent. From yesterday's low, gold surged more than $200 and eventually reached $4,527. But that still doesn't explain why it couldn't stay there, because just as the Treasury was giving gold some breathing room, the Federal Reserve complicated the picture. The latest Fed minutes were not particularly Officials are still worried about inflation, and importantly, some policymakers still believe tighter policy could be necessary if inflation remains stubborn. So the market is now caught between two very different forces. On one side, the Treasury. On the other, the Fed. And gold is sitting right in the middle. That helps explain why the rally was so powerful, but also why buyers struggled. The important question now is whether this is simply a normal pullback after an extraordinary move, or whether gold is beginning to give too much back. And this is where the chart starts to matter. The first area to watch is around $4,480. Not because that number is magical, but because after such a sharp rally, this is where we should start finding out whether buyers are genuinely willing to defend the move. If they are, gold doesn't need to immediately make another huge jump. The first job is much simpler: recover $4,500. If gold can do that and stay there, yesterday's rally remains very much alive. Then attention naturally shifts back towards yesterday's high. And that is where the next real test begins. If gold can eventually push through $4,527, the rally starts looking considerably more convincing. But if buyers fail to defend the pullback, the story changes. A deeper move lower would mean gold is giving back its surge, and at that point, the question is no longer how impressive the rally looked. It becomes how much real demand was actually behind it. But there is another chart that may give us the answer before gold does. Watch long-term US Treasury yields. Because over the past couple of sessions, the relationship has been remarkably clear. When yields surged, gold came under pressure. When those yields reversed, gold exploded higher. And that relationship matters for a much bigger reason. US government debt has now moved beyond $40 trillion. At the same time, long-term borrowing costs remain extremely high. That creates an uncomfortable problem for Washington. When you have that much debt, even small changes in borrowing costs matter. And the longer yields remain elevated, the more expensive it becomes to refinance and service that debt. That is why the Treasury's latest move deserves attention. Washington is becoming increasingly sensitive to long-term borrowing costs. And if the market starts believing authorities will push back, that could change how investors price bonds, the dollar, and ultimately gold. This is why yesterday's $200 move matters. It showed just how quickly gold can respond when pressure from the bond market suddenly eases. So where does that leave gold now? There are really two things to watch. First, can buyers get gold back above $4,500? If they can, yesterday's high comes back into focus. If they can't, the rally starts losing credibility. But the second signal may be even more important. Watch what happens to long-term Treasury yields. If yields continue to retreat, there is still a lot of money waiting to move into gold when the pressure from rates comes off. The question now is whether buyers can actually hold what they've gained. A $200 rally looks spectacular, but the follow-through matters. This content is for general information and educational purposes only and does not constitute financial advice. This is Grand Markets. Subscribe for more analysis on gold, US yields, and the macro forces driving global markets.